Joining us this morning to discuss further, economic strategist and CIO of Tuttle Wealth Partners, Francis Newton. Francis, thanks for being here.
Yes, good morning.
So the current price of Brent crude oil right now standing at about $101 per barrel. The International Energy Agency warned that the war is disrupting the supplies on a scale they've never seen before. What are you expecting throughout this day today? You heard our reporting on the ground. Maybe one or two vessels are starting to move, but still this is very much, tankers lined up and very little movement right now.
Yeah. So I think the volatility is going to continue throughout the day, and it's going to be dependent largely upon what happens this weekend. Are there more strikes? Is the strait able to open up? But just generally speaking, this is setting us up for stagflation. What is stagflation? Stagflation is where inflation is reaccelerating and growth is going down. We got our fourth quarter GDP report this morning, and it was cut in half because government spending was down and personal consumption was down. And so this is a very important setup for markets, particularly with the Fed coming up, because what's happening is when oil prices go up this high, it's for every $10 a barrel that oil goes up, you get about a 40 bips, which is, 40% of a percent. Increase in inflation, and you get a negative 10 bips in GDP. So that puts the Fed in a very difficult position. And right now, the markets are not pricing in the fact that they're going to lower rates. Without this shock in oil, they probably would have lowered rates because we see deterioration in the labor markets. And so that's kind of the setup going into the Fed meeting, which is going to continue to probably depress stock and bond prices.
What about those inflation numbers that came out, surprisingly cool a couple days ago? What does that do? How does that factor in?
Well, it's fantastic news, really, because we were headed in a direction where inflation was going down and, we had decently strong growth. But those are January's numbers. So that doesn't include the oil price shock or the bond market rate shock from this month. And so the hope is that, the Trump administration is going to try and finish this quote unquote war off very quickly so that there's a blip in the volatility, just like the government shutdown caused a blip in the numbers. And then we would return to the trend ahead of the midterm elections.
So the administration is talking about releasing, there's a couple of options that we're hearing trickle out, but they would release some of the oil from the strategic reserves and a suspension of the Jones Act that would allow ships to carry oil. How will that impact any kind of pricing? And it may not happen soon enough, right, over the weekends and that sort of thing. But how quickly could we see impact if it does happen?
Well, I think the cushion that we have there is important when it comes to the supply interruption. But I think the best bet for our numbers to continue in the trend that they were in is for this war to end. And I think, there are a lot of interpretations of what Secretary Hegseth said this morning, but basically they're going to try to be very aggressive in order to finish this as soon as possible. It was sort of what I got from it. And I just think we have to see what the developments are over the weekend. But the hope is there is a cushion there. There are delays and, the oil markets are not pricing in that cushion this morning. That could change. But I think that as quickly as we can resolve this conflict is going to be most important to eliminate or, ameliorate economic interruption.
So we're looking at gas prices on your screen right now. Current average is about $3.60 at the pump when you go. It's a nationwide average, we should mention. So it's up about 30 cents there. My question is also impacted certainly our farmers and, fertilizer prices are going up because this is a trickle down. Oil touches everything in our economy. Do you expect, because, the Pentagon said we have options, we're exploring them, but this isn't going to be an easy fix and it's not going to happen tomorrow, as kind of the messaging that I took away from the briefing this morning. Do you expect it to start impacting what we're paying, not just at the gas pump anymore, but then, at the grocery store as well? Is it going to start hitting every single sector?
Well, the way it works is initially it hits the oil and gas prices, and that, of course, puts pressure on consumers and farmers, et cetera, et cetera. And yes, that domino effect would continue to have those price increases priced into our pricing as consumers, and then that would, of course, impact inflation. But the more immediate thing that's happening is the rates. And the rates are Trump's kryptonite. Even on Liberation Day, when the bond vigilantes came out and sold U.S. Treasuries and it put rates up. And the reason that the rates going higher are our kryptonite is because we have a bifurcated economy where the lower 60% are living paycheck to paycheck. They're putting these extended groceries on their credit cards. Those interest rates then go up, and it just puts more and more pressure on the consumer. And at some point, the consumer could break. And that is the biggest risk to this economy, is if the consumer breaks and we see something meaningful in credit. Right now, we see some weakness in the private credit markets. We see that major firms are, eliminating or limiting, redemption requests. So all of these are sort of red flags. And it's just, what is the straw that breaks the camel's back? And so I think that that's why the sooner we can resolve this conflict, the less volatility is priced in advance. And that is not, because those rates, when they go up, rates are traded. They go up ahead of the Fed. That's going to put pressure on the consumer before we understand the economic impact.
U.S. economic strategist and CIO of Tuttle Wealth Partners, Frances Newton. Frances, thanks so much for being here.
Yeah.
Coming up.